you can hear me. If that's not the case, just kind of let me know in the chat, and that'd be great. Today's goal is to cover the P&L and the other options calculators available within Ivo Live. Last week we covered the probability and the options calculator, but we've also since enhanced those tools, and I just kind of wanted to point out a few enhancements to those calculators, a few enhancements to the stock monitor chain, which is also what we've covered in recent weeks, and then we'll dive into the P&L calculator. Yep, beautiful, amazing. Thank you for confirming. We are good to go on the signal. So again, since we always have a few new folks on board, when you log into iVol Live for the first time, you'll come to your dashboard. From this dashboard, this is where you're able to go register for upcoming webinars, just like what you are viewing today. On these, every Tuesday, we like to drill into a specific tool or feature of the platform. You can see that today we're focusing on our profit and loss calculator, and I'll highlight some of those new additions on the other calculators. Next week, we will be focusing on the sentiment analyzer. It's been a couple months since we've done a deep dive on that tool. And so this is where that rests. Of course, you just have to hit book, and then you're able to come here, click on the 99 spots, and then register accordingly. So that is a very useful tool and feature because it helps as we are able to dive into all of these tools. The way to think about iVol Live is it is your analytical and data platform to use to kind of help design options trades, right? So I use this. I've been options trading for around 15 plus years, and I use iVol Live as my analytical tool to find the trades I then put on with my online broker. But I use iVol Live to do my analysis, my data pulls, my charting, all of the above. So here is our friendly concierge. He's going to point out kind of what I just mentioned. These are our most popular tools within the platform. iVol Live, Stock Sentiment Analyzer. Stock Sentiment is what we'll cover next Tuesday. P&L Calculator, so we'll hit on that today. Real-Time Spread Scanner, data download, and daily updates. So here again, you'll get some of that. You have your updated toolbar. You'll see we've added since last week's webinar, we've added a shortcut to get to calculators. Calculators are by far one of our most popular tools, so we just made it easier to access those, and I'll highlight that today. You can kind of toggle with your view here, depending on what you like. And as always, for any questions whatsoever, whether that's iVol Live, whether that's our new API solution, which is great for back testing, and it's very similar to data download, or anything you may have, we're at support at ivolatility.com. So here we are. We're in our dashboard. Again, for those that just joined us, this is how you would go to register for all of our upcoming webinars. Please do so in advance. Once they fill up, they fill up. Here you'll have some of the latest news. Again, just like I kind of pointed out with calculators or with charts, it's important to have at least a couple ideas that you want to run through something like a P&L calculator, right? Otherwise, this is going to be a blank screen. So to get those ideas, I like to come here under latest news. Our system always pulls a couple really cool, interesting nuggets that merit further review, just by scrolling through. And then here we have, for example, this is interesting with Illumina. I might look into that a little bit closer. A proxy fight with Carl Icahn is always, any kind of proxy fight with Carl Icahn is normally worth digging under the surface for. So anyway, that's a good example of a nugget that might give me an idea. And then over here, under news and research, you'll see where we put out editorial. We typically do that on either Thursdays or Fridays. We kind of recap what's been going on in the week, talk about some of the trends we've been following and kind of what we're looking at. On Friday, what we looked at is volatility. And I'm going to spend some of today looking at the VIX. A lot of people don't know that you can trade the VIX or how to trade the VIX. So I think it's kind of a fun little lesson that we can show today. But, in this piece, the basic point was that, volatility is in blue here. That's the spot price. It's just gone lower. I mean, it rebounded a bit and it's since come back down and retested these lows, or these summer lows, because ultimately August typically either bleeds up or bleeds down in terms of the S&P. And when the S&P goes up, the volatility goes down. And when the S&P goes down, volatility goes up in general. And so we could see here we're at this low, but now we're into September. And September, October tend to be much more volatile months. And so what we did here is we just kind of analyzed what could be coming around the corner as we go into the fall and come out of this hot summer. And so again, we'll use the VIX as a example today because I like to, show how all of this ties in together. So we have some interesting news here. We have some interesting thoughts on the VIX and how that might go higher. From here, this is where you would progress. The way to think about this is like start at the top and go to the bottom, almost like a totem pole here. Account details is where you would update how we contact you. Getting started, this is where you would go if you were brand new and you wanted to know, okay, what is this thing and how do I get the most from it? We've recently updated this page too. It's really cool. It's got, 1, 2, 3. It's got our top 6 tools and features that people enjoy. Stock monitor I did last week. Sentiment analyzer we'll do next Tuesday. Charts I did a 3-part series on. P&L calc we'll cover today. Real-time spread scanner, very powerful tool. I did a 3-part series on that a few months ago. And then data download. And this is all these neat videos. You can always follow us on social. Speaking of neat videos, we've recently updated our iVolatility. So if you haven't followed us yet, we're at iVolatility's YouTube. We have some really, really cool videos on here that kind of explain all of these tools and the different walkthroughs. So I'd encourage everybody to go check out that recently revamped page, which is right here. And you see we have these convenient titles to let you know what you're looking at. So moving right along, iVol Live. This is where I spend a lot of my time. This is also where I go to begin any trading day. So before I pull up a calculator, before I pull up the sentiment analyzer or P&L or spread scanner, or even know what data I want to download, I come here into iVol Live and I start playing around with different ideas. I either run scans, which is kind of what I showed how to do last week when we covered the stock monitor, which is what you're looking at here. Or I have preconceived ideas, which is kind of what we're dealing with today. I've been looking at the VIX, as you can see from our editorial. I've been looking at TLT, which measures interest rates. I've been looking at Apple, Exxon, Walmart, Target, NVIDIA. And then, of course, I always have my handy charts tab. Anytime you need to pull up a new chart, you can just do so here. Again, I showed this in detail last week. You can pull up a new stock monitor tab, new futures tab, or new charts tab as you see fit. This is what we went through last week. You could see some new cool features. You're able to, kind of play around with the title here. So this was 8/29/23 stock monitor. I could do stock monitor old, or I could say refresh if I want to look at it again. Those are all the different things. All you got to do is click on this little pencil icon. For now, we're done with that list. That was last week's topic. And so to get rid of that, we would just hit the X. And here we go. A couple of cool new things I also wanted to point out in addition to having the calculator tab here. We have a calculator tab here. So now it is very easy to access our calculators. Also, too, when running custom scans, we've made it easier. So if you remember, in the past, everything used to just be listed in alphabetical order. Now we have everything grouped by category, and then you could search if there's a specific thing, for example, IVX that you're interested in looking for. You can look for all the different IVX ranges that we have. But it's really cool now because we have broke it down. All you have to do is hit the little arrow and you'll see all the different fields available for you within that overall category. So in general, we have the subcategory of company name, exchange, and quote. Within stock price, we have the subcategories of intraday price, previous day price, 52-week range, right, for a stock. Within implied volatility, no surprise here, we are iVol Live. We're very well known for our proprietary implied volatility terms and figures, and we have those ranges from 7 days if you're a short-term trader, right? So this looks at the next 7 days all the way out to the next 10,000 or not 10,000, 1,080 days, excuse me, if you're a more long-term trader, right? So those are the different fields available to you there. Historical volatility, very similar. Remember, implied volatility measures the next, trading days calendar days, and historical volatility measures calendar days, which is why, historical volatility of 20 is equivalent to implied volatility of 30, right? Because that's still going to measure 20 actual trading days. So these are the different fields available to you. Under options, we have options volume and open interest. Under fundamentals, these are all the different fundamentals that you can have. There's some overlap there with the general field. Under correlations, if you want to measure how a stock moves against the S&P, you have the different correlations over the 10 days all the way up to 180 days, and then beta, right? How sensitive is it to moves in the S&P? You have that as well. So those are some new features that literally just launched over the past week or so, which I thought were great. And so I just wanted to demonstrate those. If you're interested in any of them, you would just mark them, and then you could apply, and it would apply to this one stock monitor column. Or what you could do is you could apply it and save it as default. So anytime you pulled up a new stock monitor column, it would automatically show, in this case, quote time plus 52-week range plus, let's say, IVX 7 as an example. And all of that would automatically populate. So that is a new cool feature I wanted to demonstrate. Moving right along, after I run a couple of these scans, which I won't really do today because I already have examples in mind. But again, what we demonstrated last week was, these are our most popular preset scans, measuring by options volume, measuring any of our groups here, which is our entire universe of coverage from US to Europe to Canada and Asia. This is the IVX mean versus the 20-day historical volatility. So this is like future versus past. IVX historical range, this is like the 52-week range of the implied volatility. So it puts all these figures in context for you, and then the IVX change from yesterday, which shows where all the action is. Again, within a current group, this is all USA, right? So you're going to get small names, you're going to get large names, but then you could obviously filter that out with whichever group you are most interested in. For example, these are all from the Canadian stock market, and so on and so forth. So again, we kind of already have some examples in mind, and I wanted to start from left to right here, just in general with how I tend to look at the market when I come into iVol Live any given morning. So here you could see I typically look at SPY. It's one of the most widely followed ETFs, especially for our users. I like to come in, look to see what the price is doing. I like to look at what implied volatility is doing versus historical volatility. I also like to pull up a chart. I tend to go to the 1-year chart right off the bat, really for anything I'm looking at. But just so you know, because this question always comes up, you do, as an iVolatility user, you have within iVol Live up to 5 years worth of spot price data for any underlying. Of course, it has to be public for more than 5 years, but this is for the S&P. You also have 5 years of data for implied volatility. So here's IVX in green. And you could see, right, when the S&P plunged during COVID, you had implied volatility and historical volatility spike. And that's a good segue. Historical volatility is in orange. So what's cool about it is if you're looking for a specific data point, as long as it's in the last 5 years, you could come here and you could look for the spot price, and you could look at implied volatility and historical volatility as well, and see kind of any correlations. But typically, I like to go 1 year, kind of see what's been going on over the last 52 weeks. 52 weeks. My takeaway here is that we've had this uptrend in the S&P, then we had this kind of retracement. Now we have a new uptrend. While that's happening, we have implied volatility going lower, right? And so as a trader, I'm thinking, okay, well, the S&P is going up, implied volatility is going lower. Maybe it could be an interesting time to purchase options, on the S&P, on SPY, because again, I have this uptrend, and then I have implied volatility getting cheaper. So, this would be a good example. I showed this on our charting webinar, so I'm not going to go too far into the weeds, but I like to do things with this view. Like I like to draw these these trend lines, right? Because it helps me decide what I want to do with my trades or with my potential strike prices. As always, you can get as detailed as you would like, arrows, make it a little bold. And here's our uptrend in the S&P. And what was interesting is in past webinars I showed, we came down and we violated the uptrend. But then we leveled out here in a head and shoulders pattern, and we broke through the head and shoulders pattern where we went up and above and reestablished that uptrend. So now what's going to be interesting is do we continue higher, or do we come back and do we kiss and cross below that upward trend? But for now, this is enough information for us to run some numbers on the probability calculator and on the P&L calculator, because at the same time, we have this interesting downtrend in, let's see, it's a steep downtrend in the implied volatility, right, for the S&P. And that would be more pronounced if we came here on these shorter term charts, like a 3-month chart, for an example. What we have is you could see we've got price here going higher. Within the S&P, you can see they kissed right here. So I could draw that. We had price and implied volatility meet right at this point, which is recent. And then we had price go higher, implied volatility go lower. And we're on the 3-month chart. So I tend to go between 3-month and 1 year. But if you want to get more granular, if you want to dig deeper, you could also always go down to 1 month and see that's a bit more pronounced, where that meeting happened between blue spot price and green implied vol. And then, of course, you could go down to 24 hours or 1 day. But for now, one of the examples I thought would be nice for the S&P is our current price. We're right at about $450 a share. That's our underlying spot price. And so if we wanted to say, all right, price is going up, implied volatility is going down, what if we wanted to put on a trade? What should we do? And what if we wanted to give ourselves 30 days for that trade to work out? Typically short-term trades can be hard. We are working on a 0 DTE product, for kind of the commercial side of our biz. And as we implement that and battle test it, you might see it eventually added to iVol Live. But I like to give trades 30 to 60 days to breathe in general. And so for me, as an example, I would come here and I look at about a month out, to start my analysis, and that's on this October 6th expiration, which we have right here. So again, within iVol Live, we cover all expirations for all underlyings, within our universe. The SPY has a lot since it's a huge, widely traded ETF. So that's why there's so many different expiration dates. You could get as finite or as broad as you'd like with this column. And then you could show as many strikes or as little strikes as you'd like. I like 5 because it gives me kind of a good glimpse at the money, and then a bit out and about a bit out of the money and a bit in the money. But feel free to do whatever you'd like to do. You could go to all or keep it tight, as I like to do here with 5. And then calls and puts, right? So we have calls on the left, puts on the right. So as we look about a month out, a question becomes, all right, well, what kind of trade should we put on? So you could see we're right at, it has 451 in bold. That's kind of our at the money option. Now it's a question of should we go long or short, right? And then once we know that, we can come down to our P&L calculator and we can run the math, not only on buying a put, buying a call, but also selling a put, selling a call, or I've prepared a couple different spread trades to show you guys too on the P&L. But before I jump to P&L, I like to use my calculators. This is a great moment to show the recently updated calculators. So here we have our options calculator. This is the default tab. This is going to show you the breakdown for this specific strike price, right? So our strike here is the 451. Our last trading price, 450.67, which is right here. This is an American style option. When I show you guys the VIX in a moment, that's actually a European style option. But all this means is with an American style option, you can exercise it at any time leading up to the expiration date. You don't have to wait to the expiration. Here's our implied volatility level. Here's current interest rates. Here's the dividend for SPY, which is the S&P 500. And here's that amount. So here we can do interesting things. My favorite thing to do with the S&P is say, okay, well, between now and the next month, what happens if implied volatility changes, right? So right now we're at an 11, but what if we went up by 10 absolute points? And you can see the huge impact, implied volatility has on underlying options prices, right? Because today, this call option that we're looking at here, right? Today, that's about, $6.30. But, if implied volatility spikes between now and expiration, so like over the next 30 days, which I think it will, then this shows you what will happen to that call option value. It would almost double in value. Likewise with the put's at about 614, $6.14, and that'd go to about $10.28. So not quite as high, but close to a double. And so you could see I love kind of playing with this options calculator, especially with implied volatility levels, if I have a working theory. In the summer, I didn't really have a working theory on implied volatility. It tends to just meander because there's not a lot of volume, not a lot of trading. But September, October are notorious for rise in volatility. So you can really play around with that for the market overall. But you can also play around with this for any symbol you're interested in, right? You just have to type it in here in this box, like Apple, you would do AAPL, and then you'd be able to choose the expiration and strike, and you can play around with that. So this recently updated calculator is really neat. And then probability calculator is kind of more granular. That the probability calculator is typically what leads me into the P&L calculator, because here I'm trying to structure some kind of trade, and so what I'm interested in is one of the cool little hacks I like to do to begin with is I like to look at this expiration 10/6, and then I like to type in, price one and price two that's the same, because this helps me decide if I want to do a put, a call, or a spread when I go down to the P&L calc. And so what we could see is, according to our system, there's a 46% chance that the S&P will be below 451. So, i.e., it'll be below its current price 1 month from now. There's a 54% chance that it will be above its current above its current price, right? So, i.e., the market heading higher. Now, what's neat about this is if you're kind of a new or novice trader, you might think, okay, great, it's a 54% chance that we're going to be above 451. I should go long. I should go bullish. Well, remember, anytime you put on an options trade, you're either buying something or you're selling something. What's great about the P&L calculator is it's going to automatically calculate your entry cost. What it would cost to come into this trade. And so I'll bring this down. And so, but here you could also do it. You could also do some quick, easy math, and you could say, all right, to buy, if I wanted to go long, if I wanted to go above the current price, I'd buy a call as an example. Well, 451 plus the current price, about $6.20, means, we at least need this thing somewhere around 458 by expiration, right? So this cost plus the current share price of 451. Now we can rerun that math and we can see, look, what's great is the P&L calculator is going to show us where we make money and where we could, potentially lose money. But what this also tells us is, it's kind of a long shot, right? There's only a 36% chance that the S&P will be above 458 going into the expiration. Now, that doesn't mean by default it's a terrible trade, because as we just saw, if implied volatility goes up, the price of these options will go up naturally, right? The puts and the calls. So there's still a chance that buying at the 451 strike could lead to a profit along the way. All this is saying is if you're banking on the S&P being above 458 by expiration on 10/6, that's probably a bad bet, right? There's only a 36% chance it's going to happen. On the other hand, there's also only a 46% chance we'll be below 451. So as a trader, what I'm thinking is, all right, maybe it doesn't make a lot of sense to buy a call because my cost is too high, and it's unlikely that I'll expire profitably. But if I still want to be bullish on this trade on the S&P, which again we saw our chart is moving higher and implied volatility is moving lower. If I still want to be bullish, I could sell a put. And if I sell a put, there's only a 46% chance I'll get put at 451, right? Because there's a 54% chance that the S&P will be above 451. So in this case, the numbers I'm going to use as I go to the P&L calculator is I'm going to say, all right, well, what if I got paid $6.27 a share today to sell to open this put option on the S&P, right? And so, I would come here and also too, like when you're selling the open puts, it is a bullish bet. But what you're also doing is you're lowering your cost basis. So as we were buying this call, we were adding to our cost basis, 451 plus what it was costing us. When you sell an option, you're reducing your cost basis, right? So it's 451 minus the $6.25 you're being paid to enter the position. So it's really like buying the S&P at like say $4, 445, right? So again, we could come here, right? So we would jot down our 10, 6, 23 expiration. We would come to our P&L, our handy P&L calculator, and we would say, okay, we are interested in running some numbers on SPY. So here we go. Type in your symbol, hit find chain. What's going to happen is this is how you would set up your initial trade. Once you have a strike price on your screen here, you're able to just add additional option legs and you can change the action to take, right? You could change the buy, you could change the sell. So I'll show how to do that. But for now, let's keep it pretty plain Jane and let's go to our specific strike. As I mentioned, S&P SPY is very, very liquid and has a tremendous amount of strikes. So we'll scroll through that. Here we go. Let the system load. Here is our 10.6, and then we were looking at the 451 right here. So again, puts are on the right, calls are on the left. Since I'm looking at puts, as my bullish bet, I would click on the put, and that will populate this specific trade behind me. And what's great about that is all this information that you saw on the options chain, like these important pieces here, are going to translate over to my main screen for further analysis. So here we are. We have SPY. We have various potential stock prices, right? If SPY dropped to 250, here's what would happen. We'd be down $19,428. If the SPY moves higher, here's what would happen, right? And obviously, when you sell an option, also it's important to keep in mind for any newbies, when you sell an option, your profit is capped at what you sell the option for, right? That's kind of the trade-off. When you're selling an option, you're capping your potential profit with what you sell it for. When you buy an option, you have, in theory, unlimited upside. The issue is you have to get the direction right, the timing right, and you have to pay the right price when you buy an option. So that's kind of the trade-off between buying and selling. For now, what you can see is our action is sell. So we're selling this October 6th, 451 put, which means we're going to earn $6.23 a share. Since options trade in increments of 100, this would be like earning $623 today. Let's say your broker ultimately gave you a better price, though. We could always update that here, 650. So we actually earned $650, and you can see our P&L updated with the fact that we earned that higher premium. So our max potential upside is now 650. Here's our implied volatility. Again, it's low, 1176. That's just the result of the VIX kind of drifting lower and the market drifting higher over the summer months in general. Here's the delta for this specific option leg. Here's the gamma. Here's our theta. So this is saying, hey, every day between now and expiration, 31 days from now, we'd be earning 6.46 on our option just in time decay. And then Vega. So this is, how sensitive this option is to underlying changes in the implied volatility, which, speaking of, you can play with implied volatility not only on the options calculator screen, but you could do that here on the P&L. So you could say, all right, this is my trade in general, but what happens, again, if implied volatility goes up by 10 absolute points? So we went from 11 to 2176. All of this, you could see how much the theta jumped. It more than doubled. And Vega stayed about the same, but you could see all the impact on the Greeks, and you can see the impact on the P&L as well. Other cool things that you could do from this view is you could say, well, what happens if we get closer to expiration? And you can either click here and go to your target date on the calendar, right? So that just changed from 31 to 15 days, the expiration, and all of that updates in real time. Again, since we're selling to open this put, our P&L won't change in terms of our max upside. But everything else too will update in real time. You can also bring this scroll bar over, days to expiration 7. So depending on what you prefer, we could say, okay, well, what happens when we're 2 days out? And everything will update. Now on this chart, what you have is this blue line is your break-even point. And so this is, kind of the intersection of what you're paying, what your cost basis will be. So again, since we're selling to open this, our cost basis is a bit lower, right? Because we're going to enjoy earning this premium. If we were buying this, that changes, right? So we're buying this for 624. So now our cost base is updated, right? And our break-even point is different because we're spending money to get into this options trade. And here we're buying the put, so all of a sudden this flip-flops. Here we're making money as the S&P goes down, right? You can see now at 250, we're up that 19,455. And then we're losing money as the S&P goes up. So you can see all I did was I clicked on this action. The other thing you could do is you can invert the chart, and that will automatically reverse the action, which is also a neat little hack. So you can play around with volatility, play around with days to expiration. In general, I understand what's going on with this trade. I'm going to make money as long as the SPY stays above this break-even point, right? 446.30. Other things you could do within the P&L, you could play Federal Reserve Chairman if you desire. You could play around with interest rates because interest rates do have an impact on options pricing. You can also play around with dividends, as dividends do as well. So, if the idea is that S&P will be raising its dividend, which it tends to do over time. In general, the index tends to have these small incremental rises in the dividend amounts. You could play around with that, here. Say we went to 195, and that would be an effect on the next quarterly dividend payment here. Let's say at the end of September, apply, right? And it would show the updates there. So if you have a stock or an index, even like the S&P 500 that you follow very, very closely, like religiously, you can go in these advanced settings and really play around with things like that and see, what it would do to the options price. So that is an example on SPY, just a very, kind of simple analysis of saying, hey, look, S&P is going up, VIX is going down. Let's see if we can get in and play that trend. Now, if volatility does come back in September and October, typically that will correspond with a downturn in the market. So I have a couple different things I want to show you guys on the VIX. So I like to look at SPY kind of first, get a general gauge for the market. So I kind of alternate between whether I go to the VIX or SPY first. But here on the VIX, we could see the current price is 1381. And we come here, pull up our chart. Like I said, I like to start at this kind of 1 year level, but you could go as far out as 5, as low as a day. But here on the 1 year, some quick takeaways are, check this out. We have this interesting trend developing. We have price going down, right? So the VIX has been bleeding lower, but we have implied volatility spiking. So this is how I know something's going to happen, right? So something is going to happen that causes an uptick in volatility. And so this is a perfect moment where I would come here and I would show this, right? And then I would save this in my trading journal. And I would say, okay, beware for spike in VIX, right? Because this is telling me something's going to happen, right? These will stretch only so far apart before they revert back and start closing in on each other. So for the VIX, what was interesting here that I wanted to demonstrate is the VIX is European style, and we haven't really ever talked about recently, how to trade the VIX. So, if we wanted to look out again just 1 month, that'd be around here, around this October 4th expiration. Right now we're at 1378. So the question is, are we going to go higher or are we going to go lower? And you can trade the VIX. So if we click on the calculator here, this is kind of how I would look at it. I would come to when we're looking at a directional trade, I go straight to the probability calculator. And then again, I type in kind of right around the current price. 1350 is our, I'm looking at 1350. You could use either 1350 or 14 because those are the, two nearest strikes. For now, let's just do 13.5. And so what's interesting here to me as a trader is we have a 48% chance that the VIX will be below 1350 on October 6th, right? Or October 4th, one month from now. But we have a 52% chance it'll be above 1350. But we have a 0% chance it's going to be, of course, between the two. But what I like to do when I see something, this tight, is that, we can look at doing either a straddle or a strangle option strategy. And so to help find strike prices, I could say, all right, well, let's widen out our two strikes a little bit, So let's say 1350 on the low end and then 14 on the high end, right? Because we can get cheaper as we kind of play around with the strikes, cheaper entry prices. So again, there's a 48% chance we'll be below 1350. There's only a 44% chance we'll be above 14. So it really looks like we're going to stay somewhere between 1350 and 14, right? Our current share price. So then I can use this information for a couple interesting things. So in general, one of the hacks I like to use as an options trader with IVOL Live is I like to look at with the VIX. The VIX is European style. That means you can only exercise at expiration. You don't have any opportunities to do early exercising or early assignment. And so what I find interesting is when you have the same strike price, the VIX, but then you have wildly different prices for calls and wildly different prices for puts. So you can see the ask for calls and the ask for puts here expiring tomorrow is pretty close. It's not that far. But if we go out to next week, right, September 13th, an interesting trend starts to emerge. You start to see that the VIX call options are much more expensive, almost 3 times as expensive as the put options. And what does the VIX call option mean? The VIX call option means the VIX going higher, right? So the market makers are basically have these things priced 3 times higher to bet on the upside than on the VIX going lower. And as you go out, you can see this trend continues. Now we're into September 20th. Now we're in October. October 4th, like look at that, to go long calls is almost 7 times more expensive than to go long puts. So, this is typically when it's so lopsided in terms of pricing and when the chart looks like this, it's almost a shoe-in that the VIX will be higher, in the coming weeks. So some cool things that I set up within the P&L calculator for the VIX that I wanted to show. You can see here, I just skipped ahead a couple steps. We have the VIX symbol, we have our current share price, we have the different share price here in our table, the different P&L here, but check out what I've set up. So this is a straddle trade. And the way I did that is all I did is added an option leg. So again, once you have your underlying symbol in at least one option leg, you can just come here and you can add as many option legs as you want, to the trade. So in my case, I designed a straddle. And what a straddle is we take our current share price, right? This is the gut strangle. Let me come here. This is our straddle on Apple. So here, what I did actually is a strangle. And what a strangle is we're strangling the current underlying share price, right? So we're right at like 14. So I have a 13 put right on the downside, and I have a $15 call on the upside. And so what a strangle is asking is it's basically a bet saying, look, our bet here is that we don't know what's going to happen. We just know that it's not going to stay at the current price. And I'm confident in that bet. I don't think the VIX is going to stay stuck here at first 14. So we either want to bet on it going further lower, right? If the market shoots higher, or we want to bet on the VIX going higher, right? If volatility comes back. And so I just designed a very simple strangle trade here where we're buying the $13 put, which is going to cost us 17 cents. We're buying the $15 call, which is going to cost us $1.86. So we're in all in at about $2. So this would be 200 bucks to put on this trade with your broker. But you could see what's cool about the P&L calc is it's so easy for me to see where this thing makes money, right? Our break evens in blue. And I could see, look, I'm profitable as long as this thing goes above, right at 15 a share. And I'm profitable as long as this thing goes below, call it like 11.50 a share. I could see that visually, and I could see that over here in the chart form, with my tables. So that's what's great. Now, the only way we lose money is essentially if the VIX stays within these levels, right? If it stays within 12 or 13.50, based on the cost that we're spending to get in this trade, that's where I'd lose. So if the probability calculator told me it was a huge probability that the VIX would trade between 12 and 13.50, then it wouldn't make sense for me to put on this trade, right? Because I'm gonna lose money. But so long as the odds are that it's going to move either higher or lower, like a straddle or a strangle, in this case it's a strangle, we're strangling the price in between, then that could be a very, very good bet, right? A very interesting bet. So now continuing along, I have an Apple example I want to show you guys. So let me come to my Apple tab. I'm going to skip over TLT in the interest of time. Apple, of course, is one of our popular names. It's one of our most viewed names on our platform. We've used it from time to time in our webinars. And so Apple, what Apple has coming up, if we just go back and start here at a 1-year chart, my quick high level observations are we had this big uptrend, a retracement, and now we have a new uptrend. At the same time, we have implied volatility going lower. We can see this more pronounced here. Like if we go to our 6-month chart, here we go, a nice little separation between price and implied volatility, beautiful little gap forming. And so some of the things I could do, I also looked ahead to the earnings announcement. We're also working on an earnings product, but not quite implemented here in iVol Live, but I just looked ahead to the earnings date, which was 10/25 for Apple. So I said, all right, well, look, we have a new uptrend in Apple. We have implied volatility going down. So that means the options prices are getting lower. What are some interesting trades we can make before earnings? So if earnings are 10/25, we'd need to do something around 10/20. We could come here to the options chain and then click on our handy calculator tool. Again, in the interest of time, I'll skip ahead to probability calculator. And, with earnings coming up, I wanted to analyze, all right, well, if I wanted to be bullish or if I wanted to be bearish, what's the best way to go about it? And so let's come here and we have our current price at 189. So my question would be, all right, well what's the likelihood we are at 190, which is basically where we are now, at the money at expiration on the 20th, or what's the likelihood Apple's going to rip higher between now and then? So you come here, you can see there's only a 48% chance we'd be below 190. Translation, this could be a great put, sell to open, just like what we looked at it with SPY, because on this 190, we could earn $4.65 a share, agreeing to buy Apple at 190. And there's only a 40% chance we'd get put. And even if we did get put, if we're long-term bullish, that could be a great cost basis, right? Because you're in a 190 minus 4, so in around $1.85 a share, which could be a great entry level in theory. And then on the other hand, what's the chance that we'll be above 195, which is our next strike here, right? And we could see to get into this trade would cost us $3.30 around that, but there's only a 37% chance we'll be above that share price at expiration, right? The other thing you could do is you could look at in the money, so 185, let's say. So if we want to know, what's the chance we'll be above 185, there's a 52% chance we'll be above 185. To buy that call option would cost us about $8.90. So we would need to then put this trade through our P&L calculator, because that will tell us, hey, based on the fact it's going to call us $8.90, yeah, we're going to have a high delta, right? So that means that as Apple, if it does move higher, this 185 call option would also move higher, kind of in lockstep, but it's going to cost us more to get in, right? And so we would run that math through the P&L calculator. But what I thought was interesting was I designed a let's see here. Okay, here we go. Apple. I designed a straddle on Apple. And a straddle means we're straddling the same strike price and the same expiration for the same company. So here's Apple. So here I said, well, what if we basically say, and I went after the earnings. Remember, I said earnings are on October 25th. My theory here is we don't know what's going to happen in the short term, but when I ran the math on the probability calculator for the 190 for the put and the call on November 17th, it was pretty much dead even, right? Which means our system doesn't know if it's going to go higher or lower, but it will go higher or lower. The chance of it staying at the 190 was something like 2%. So what's great about this is you can create this straddle trade here within the P&L calculator and would say, okay, we're buying this 190 put on Apple, it's going to cost us $6.90. We're buying this 190 call on Apple, it's going to cost us $8.20. So we're in at like $1,500 is what the spread would cost us. Here you could see, our potential P&L, right? Which again, as long as this thing moves higher, at least to 200, we start making money. And as long as it moves lower, at least to 180, we start making money. The only way we lose money is if Apple does nothing, right? So what would have to happen is as earnings come out, Apple goes nowhere. It just stays where it's at, more or less, marking time. Then what would happen is these options would decay, and that's how you would lose money on a spread trade. And again, to find these spreads, I've been trading them a long time, so I just kind of create them in real time by adding option legs here, right? So we could continue moving and adding options legs as we see fit. We could also start from scratch by removing all. You can also add a stock leg. In a future webinar, I'll show how to create and analyze all of these spread trades by using our spread scanner. So I'd be able to use this, type in Apple, type in the strategy I want, and it would give me all the different scenarios for Apple for that particular strategy. We don't have time for that today, but that is another really, really cool tool once you have something like Apple, where you're very confident it's going to move in the future, but you need to design a trade to capitalize on that. The other thing I'll show real quick is another popular feature to the P&L calc. We have a lot of users that do covered calls. And so what we can do here is we can add stock to the calculator. I'll just show you how versatile this thing is with a few mouse clicks. So right now we're adding the stock. So we're going to buy 100 shares. We're going to eliminate this put since we're doing a covered call. And we're going to sell this call. So you can see with a few mouse clicks, we just totally changed this from a straddle option spread trade to a covered call trade, right? So we're buying Apple at the current price, 189.62, and we're selling this 190 strike against our shares for $8.15. So we'll earn that money. But you can see, our upside is capped based on the difference between 189.62 and a 190, right? Well, if Apple's trading at 190 or higher, we're going to get called away. So we'll make this profit between 190 and 189.62, and we'll keep this 815. And so all of that is displayed here in visual form. Other cool thing with covered calls, if you like to be delta neutral, you'll see here that our delta is 56.99. So if you wanted to be delta neutral, right, just as an example, maybe you would sell 2 contracts, you'd make double the income, right? So you'd make $1,600, you'd be delta neutral. And that's one easy way I like to kind of look at when I'm looking at covered calls within the P&L calc. That's a nice little tool that you can use as well. Any questions on the P&L calc? This is our guide. So all of our tools have these guides where you're able to pull them up, and they always have a table of contents. They're always very well done. If you have something specific in mind, you could hit always Control F and just type in whatever it is that you're interested in finding within the guide, and this will show you how to do multiple positions, multiple legs, and it will kind of dive into granular detail on whichever topic you are interested in. So again, just as a quick recap, what we did in today's webinar is we showed the new ways to add different features, from these tabs on the stock monitor, like our newly organized custom criteria that you can filter for. Then we showed our new calculators and how to pull those up and run those, which then as you use those calculators and you understand the pricing or the probability of a position, like what we're looking at with Apple. After that calculator step, we move on to the P&L calculator step, which we just showed. And next week, we'll cover Sentiment Analyzer and how to run scans there, and also how to analyze specific stocks. Like I want to look at some of these energy stocks, for an example. Like I've really been looking at retail as we go into the holiday season. So I've covered that in past webinars. Walmart versus Target has been an interesting kind of King Kong versus Godzilla. And then energy has been very interesting because energy has been rocketing higher. Let me just pull this up real quick. The trader junkie in me wants to show it. So we have spot price going much higher. We have implied volatility going much lower. But again, so you say, oh man, let's go bullish, right? Let's just buy call options with reckless abandon and make a ton of money. But it's never that easy, right? And so like we could come here. I looked at Exxon too. This one I just showed. They have earnings 1026. So I was looking at maybe a trade before the earnings announcement. And so that would be on this 10/20 date. And I was looking kind of around the money, right at the money. And I came here and I wanted to see what the chance was that we'd be above 115, right? And there's a 50% chance. But then I said, oh, well, it's going to cost $3.65 to get into that trade. So really I need to know if I buy a call option, if I get super excited with this upward price movement, really I need this to go above 119. And there's only a 32% chance, right? So if I just go crazy and bet on the upside here by buying calls, based on what they're priced at, even with implied volatility going lower and making these cheaper, it's still maybe not a great time to make a bullish bet by buying a call. Of course, we could structure a bullish bet with a spread trade, or we could sell puts. But just in general, it's kind of I love using these probability calculators because, it's never as easy as just seeing a blue line going up and wildly buying calls, right? It always takes some analysis on the probability and then running everything through the P&L calc because it accounts for the cost of getting into trades, whether that's a spread, a put, or a call. So with that, I'm going to take a sip of my water here. I hope that was very insightful. If there's any questions or feedback, please put those in the chat. We always love feedback here, so we know that we're adding value. And two, I'll get this real quick. For anybody that's not currently an IVA Live user, here are the different options to become an IVA Live user. We have a 7-day free trial no matter what you choose. And then within that 7-day free trial, we have the Pro Real Time. We have, which is what I use today. So all those numbers we're updating in real time. Our cheapest way to get involved is through our annual plans. But again, everything offers a 7-day free trial. So we have Pro Real Time, which is what I use, which has all the tools. Advanced, which still has the P&L calc. It just doesn't have the real-time spread scanner. And then Basic, which does not have the P&L calc. So you would not be able to use what we did today under the Basic subscription. Again, for anything else, we're at support at ivolatility.com. It looks like we are good. We're coming up against the hour. So thank you guys so much. Again, we always enjoy bringing these to you. Thank you for joining us. And until next time, happy trading.